So thanks for coming to another one of our webinar series, advanced webinar series for OpenAir. Today's topic is advanced cost tracking. And we're going to focus more on hourly cost tracking, but there's also things like expenses and purchases that you'll be interested in hearing about. The agenda will be, what kinds of costs can you track or are tracked in OpenAir. The concept of cost centers, you may be using them, but making sure that you understand how they work in OpenAir. Maybe some other approaches to dealing with cost centers or roll-up of reportings by cost centers. There's cost center options by user, and then there's labor cost approaches on how to manage labor cost as it's tracked against projects. And then, of course, there's expenses and purchases, which are both costs against the project. And then reporting, it's actually a very short topic in this presentation because you could go on and on and on about reporting and costs and profitabilities. But the focus is more on how costs are tracked and worked in OpenAir. And then if there's any questions, of course, at the end, I'll take those questions. So the types of costs in OpenAir, this is not surprising to many of you. There are three main types of costs. There's labor cost, people putting hours into the system. There are expenses, travel expenses, maybe reimbursable expenses, phone charges, things like that. And then there are products or services, which could be purchases. And those are usually treated as things like a vendor purchase order or something called a quick purchase order or a quick PO as it's known in OpenAir, which basically records a cost against the project, maybe something like a fixed price subcontractor cost or some type of material cost like a server or a laptop that you've had to purchase. The fact that costs are tracked in the system, costs are usually associated to a project, just like many things in OpenAir are usually associated to a project if that's your configuration, which 97% of the users have a project-centric OpenAir system. And they may also have a user relationship, like expenses are expense reports and labor costs are people. All of those costs, though, since they're related to something, can be tagged or tracked as part of a cost center. And you can actually set up a cost center according to the way that your organization structure is, and ideally the way that your accounting system is set up. So cost centers right now in OpenAir can be set up on the user records. They can be associated to clients, to projects, to individual tasks within the project, so you can override your cost centers there, to expense items themselves, to the time type feature, which some of you may not be using, but it's an additional category field that you can add to the timesheet when you're entering time. And services. Services are used quite a bit throughout the OpenAir system, especially when there's integrations and keeping track of accounting, chart of accounts type thing, general ledger accounts. So these are all the places that a cost center can live, but you may be asking the question, well, I do have cost centers set up in the system, but I'm not seeing a cost center field on any of these things. And that actually is directly related to how you set up these inheritance rules for cost centers in the system. So within the administration module, or for those of you who are on the account module still, you'll see cost centers as a value field, an area where you can add values into the system and create a series of cost centers. Cost centers are really nothing more than a name. However, how that name appears or is associated to a piece of cost, like an hour on a timesheet, is directly related to these rules that you put in place and how the cost is inherited according to the settings across these different items. So I'm going to go into the system here real quick and kind of show you some examples which are easier to understand if I'm talking while I'm illustrating. So if I go into the cost centers, I have a list of cost centers. I have 3 cost centers, US, France, and India. And I go into time entry rules, and I have no rules set up, which means none of these cost centers are actually going to be available to set on fields. And that seems strange. Why do I define cost centers without actually being able to associate them? That is strange, and you should ideally set up at least 1 or 2 rules for your time entries and your receipts. And what do I mean by rule? So let's say that you have a user cost-driven model, where the cost follows the person. It doesn't matter where they work in the country or the world for your organization, the cost follows them. Okay? So you would actually put on your time entry rules that the cost center of the user is what is associated to the time entries, where the cost comes from the hours of time worked. And you could do the same thing on your receipts. Okay. But what if you're in a model where it said, well, it follows the user unless it's a subcontractor, and the subcontractor in that case needs to, maybe it follows the project or something. And in those cases, it could be you set up where you say, I'm going to pull it from the user unless the user's field is blank, because a contractor could be shared across different organizational cost centers. So a contractor may have a blank cost center value, and then since the user field is blank, it would then look at the project to pick up the cost center, and that's what would be associated to the hours for that person. And so the way that the rules work is it looks at the first field in this list that you set it up, and then if that doesn't have a value, it drops to the second field. If that doesn't have a value, it drops to the third field, and so forth. A common mistake I see is people putting it in the order of user, project, task. And then they set something on the task, and they set something on the project, and they set something on the user. And what they're expecting is that the last thing there, the most granular thing, which would be the task, would set the cost center. And that's not actually how it works. You would have to reverse this list, basically. So you'd pull it from the task first, and if that's blank, then the project, and if that's blank, then the user. Okay. So if you didn't know about those rules, that's actually what causes the cost center field to actually show up on the forms. Because if the rules say that I have to pull it from a certain place, if there's a value, then of course it has to give you the field to be able to populate it. So in this case, the cost center field would show up on the task and the project and the user form, but it would not show up on the client form because I did not put that in the rules. Okay? So that's a little bit more about cost centers if you weren't aware of how they actually worked or how they were set up in the system. Now cost centers, the good thing about cost centers is they're sticky values that I like to call sticky values, which means the minute that a transaction is saved, a time entry is saved, or an expense receipt is saved, that cost center gets stamped onto it. Okay, so that's great for reporting because even if you change a cost center on a task or a project, it won't impact history because the sticky field is left on the transactions from history. Okay. But the bad news is it's a sticky field, so there's good and bad to it. And the reason it's bad is the cost center, the minute that you change the cost center, let's say a person transferred from one cost center to another, and they transferred on the 1st of July, but the HR department didn't get the paperwork until the 10th of July. So they come into OpenAir on the 10th of July and they change the cost center. Okay. Any time that's already been entered as of that day has been stamped with the old cost center. So July 1st, 2nd, 3rd, all the way up to the 10th, potentially, if the person's been putting their time in daily, which of course I know everyone does, right? The sticky value of the cost center is the wrong sticky value. Okay? And to change the sticky value requires you to actually use that integration manager tool that you may be knowing, that you may have heard about, or it's called OpenAir Connect in many places now. And it's a database cleaning tool basically, and it requires a lot of training and making sure, because you're messing with the database integrity, and you'd have to update the cost center that way. So the good and bad news of the cost center is it's sticky, but there's no date index that you can control. The minute you change it is the minute that the values going forward would inherit the new values, and the values historically would have the old value on it. And if there's any kind of delay in paperwork, or we all know, the day that you transfer is not necessarily the day that the data gets updated. You may have a little bit of a data integrity, a reporting problem. You may have some roll-up cost reporting problems. So there's a way that we've actually been able to work with some customers, and it's using this user entity tag concept. Cost center is still very important and used quite often, but you can actually consider basically implementing a cost center structure using these user entity tags. And this is an optional feature that's turned on at the user level, and it creates another link on the user record, and it gives you the ability to set up basically what's called a tag group, and the tag group has a series of values that you can associate. So in this case on the screen, I'm showing you a tag group of department, and the values in the department are EMEA, US, and APAC. Okay, so the nice thing about the entity tags is that it allows you to pick a current value. So right now in the screenshot that you see, the person is in the U.S. department, but if you look down at the bottom of the form, historically the person, as of August 1st to the end of December in 2011, they were actually in EMEA. So what this means is this person transferred from EMEA to the U.S. department after the end of 2011. Because it has this date index, it really gives you a nice option to consider. If you have strong cost center roll-up reporting requirements, you may want to consider using user entity tags and not the cost center function, because you can control dates more easily here. The cost center function still has a sticky field. The user entity tags are not sticky fields, but they have the advantage of having date index fields. And so when you include them on reports, they will pay attention to the dates associated to values and include the person in the right time frames under the right quote-unquote cost centers or departments, however you want to roll those up, so that you would get the right roll-up information. Okay. The only other downside of using the cost centers is there's no inheritance. So basically, even though you may have, like I showed you, that task project user, so whatever the value is, I follow the cost of the person or the task or the project. The entity tags don't allow you to have an entity tag at the task level. It's just at the user level, and that's it. So again, goes to your reporting requirements, how critical they are at the cost center level. If you have more of a user-centric cost center reporting, user entity tags may actually be a good way for you to go. If you have more of a project and a task-based focus, there are other options like some service levels that you could use that may work better for you. Okay. So speaking of cost values for these hours and cost centers, you define the cost of a user on the user record itself. There's one of those links in the user setup. It's called cost, and when you open it up, you can put the current hourly cost in there and the currency of the cost number, what that represents. And below that current value, you have the ability to put start and end date indexes of previous cost levels. Why is that a big deal? Well, it's good for things like performance changes. Year after year, people get maybe a cost of living raise, or they transfer departments, or they get a promotion, and their cost changes. And so you want to be able to accurately reflect the cost that they are impacting projects in the company based on those salary impacts along the way. But a lot of times I get questions of, well, I'd like to track different types of costs, because the challenge is always when people talk about tracking one value of cost, what does that cost mean and who should be able to see it? Typically people jump to the, well, I'll just do it, it's salary times 1.2 or something like that to account for benefits and office space and equipment and so forth and so on. So you get some approximate of the salary. But then the other question comes up, the person on the other shoulder says, well, but you really want people to see that, because if they find out what the factor is, they'll be able to work backwards and find out the person's salary. We really can't expose that kind of information to people lower than the management level. So maybe we should just stick with banded costs, which is a great option as well. All project managers are at one rate. All senior consultants are at one rate. So then it's known that if you're in different jobs, you would typically cost different to the company. But that means that your cost tracking is an approximate. So you're sort of hitting an approximate margin, an approximate cost, and an approximate profitability based on people. So typically we get the question of, well, I'd like to have the best of both worlds, so how can I do that? Well, OpenAir has the ability for you to actually track more than one cost per person. And the huge advantage of this is not only being able to have one that's very close to salary, and then one that's more of a banded cost, maybe a PM one that you can share for banded and a salary one that you share with executive management. But you can also control who has access to these costs by the role definition. When a person logs in and they are assigned an OpenAir role, you define which costs they can actually see. And they would never be able to run a report or see any costs that are in a different bucket, for example. So there's a big advantage to implementing the more than 3 or more than 1 costs. And for those of you who are curious about how that's turned on, it is an internal switch. You do have to email OpenAir support and ask them to increase the cost levels on the user from 1 to 2 or 3. The maximum is 3 right now. So other than the example I gave you, which was the salary versus the banded cost, so you can identify who can see what kinds of costs, other examples that have come up that have been able to be solved with the multiple cost rates on the user record is something I've talked about in previous webinars, things like capacity planning and target bill rates. So if you actually dedicate one of those levels to be a target bill rate, basically every hour that a person puts on a timesheet can be, the target bill rate for that hour should have been, maybe $50 an hour, and then based on what the project actually is doing, the project may have been discounted to be $40 an hour. So now you have an ability to track what was your target bill rate for that person. So what should the project cost should have been based on the hours versus what was actually billed based on negotiated contract, and the difference obviously is sort of the opportunity loss based on negotiation. So target bill rate can be something, and I'm going to show you in the reporting section why using these cost levels actually give you a really easy way to pull in reports and values for reports without doing extra calculations. And another option that came up, some of you may be using the incurred versus forecast rule or have always wanted to use the incurred versus forecast rule for revenue. What that rule does is it's a percent complete based rule, but the percent complete is based on the cost of each hour of the person that's worked. So if a person costs $100 an hour and they work 2 hours, they're going to recognize twice as much revenue on the project than a $50 an hour person that works 2 hours. So it's based on an amount of cost. But if you just make the cost be a value of 1, that means the expensive person and the less expensive person actually have the same cost, which means their hours contribute the same, which now turns it into a percent complete hours-based incurred versus forecast. Why wouldn't you just use percent complete as a revenue recognition rule? The only advantage incurred versus forecast rule has is that it allows you to automatically divide up the revenue per person. I know some of you on the phone perhaps are wondering, gee, I've always had to export in a spreadsheet and divide out the hours and the revenue and allocate it by person because you may have compensation based on revenue or some kind of KPIs based on revenue earning per person. The incurred versus forecast rule can actually do revenue per person on a percent complete basis. So I'll just show you that rule real quick if you're not familiar with it. It's a real simple rule. What's the cost baseline? So that's the forecast cost baseline. So that's usually like bookings perhaps or the assigned hours. And then what's been incurred based on approved hours on timesheets. And then at the very bottom, you just click this here, create a recognition transaction for each person, and it'll divide up the percent complete among the people for that time period that you run it for. So it's pretty handy. So great. We have a cost per hour. We understand that we can have a different cost per hour, and you can make some decisions as to who can see what costs. Maybe use one of those cost rates for other robust reporting like target bill rates or the incurred versus forecast rule. That's all good. But another problem starts coming in. So there's always these things related to cost. And one major problem is the decision or the decision basically on how many hours contribute to cost. And really what that means is people will record, or as a best practice, I encourage people to record all the hours they work on a project. So if you work 50 hours in a week, you record 50 hours against the project. If you're a salaried employee, you are probably not getting any kind of overtime or additional monies from your payroll because you put the 50 hours in. You put 40 hours in because your 40 hours is what salary is covering. The extra 10 hours, obviously you may be working something out with your manager. But in OpenAir, those 50 hours are the same cost for every hour. Every hour is the cost that you put into that cost field, and so now the project has incurred 50 hours worth of cost, when in actuality the user is only costing the company 40 hours of cost. So you have you've overcounted cost by 10 hours. So usually you see, there's two theories in the tracking of this, and I see the reasons for both, but it really depends on your methodology and your financial policies. So one is every hour should contribute to cost, which then impacts profitability. So in general, the project profitability should accurately reflect the fact that I did all of these hours against the budget of hours, and therefore my profit is X. Okay, I budgeted 10 hours, I worked 12, I lost money, for example. That is a good approach when you're dealing with KPIs, especially if you want to refine estimates. We keep underestimating the testing window. We really need to make sure we get better at that, and so therefore we're going to increase that section in estimating so we don't kill our people and we're working lots of overtime to try and get stuff done. Okay, so there's a valid KPI there that I don't want people to think, oh well, it's all free hours. It still impacts your estimate. The other view is those 50 hours should not be the same value hour for hour. They should be adjusted to the fact that they're only worth 40 hours worth of work. So you basically reduce the cost by, what, is it like 10% or something like that? You reduce the cost per hour so that the 50 hours that a person worked this week is still the same cost as a 40-hour work week. That does make the profitability more accurate on the project, of course, because what that means is you're only accounting for the salary the person is earning, not every hour that they work. The overtime work may be considered free. Now that is good from a financial perspective because bottom line for the company, of course, those 10 hours, for the company, those 10 hours may essentially be free hours, but I hate to see anyone encourage, okay, we're going to estimate this to be 100 hours. It's going to take 250, so we're just going to make everyone work overtime, and we'll still be able to come in under budget. The concept doesn't really jive from an estimating perspective. It may happen, but that's not how you should plan work as a best practice. So what options do you have as far as accounting for both of those reporting approaches? One is every hour has the same cost as, whether it's overtime or not, and the other is if somebody works overtime, that the cost per hour is reduced. There's actually a report. It's under the advanced section of OpenAir called the Historical Utilization Report. This percent historical utilization report allows you to take the hours that people have worked, and based on their utilization, let's say they're 120% utilized in the week, it would normalize the cost of each of those hours so it would bring it back down to the cost of a 40-hour work week or 100% of the work week. So what you do is you run the report, and I'll show you the report here in the system. You run the percent historical utilization report. You have to define the period across which the adjustment happens. Okay, so there's a lot of things to consider before you do this cost adjustment, and a good process definition is really required here to make things workable and data interpreted correctly. So here I'm going to say that I'm just going to go across an entire month. I'm going to look at an entire month. I'm going to adjust the cost for all the hours in that month according to the number of hours people worked and normalize it back to a normal work schedule, a full work schedule. 40 hours a week is what my work schedule is. Things that you can also consider in this report are what contributes to utilization, and we'll talk about that in just a second. Like what do you count as an hour worked so that you would normalize correctly? And I'm going to run this report. The report will come up and it'll say, look at all these individuals, and this is their average percent utilized. And what I did was I included everything, every time entry on the report. It could be vacation, it could be holidays, it could be sick time, it could be client work, It could be training, whatever. I included it in there. So you can see quite a number of people in this report are over 100%, which means they are working more than 40 hours a week typically. And down in the tips area, what I can do is I can say, click here to adjust user's loaded cost. What that means is it's going to pop up and it's going to say, for this period, which is the period of December 1st to the 31st, it will actually create a cost dated adjustment in the cost table of the user to normalize these percentages and the cost per hour down to basically a 100% utilization. Okay, so I'm going to overwrite existing costs and run cost adjustment. So what this means is, and I'll go take a look at these records so you can see what it does. So I ran this for the month of December, and for anyone, let's say a couple people were 130% utilized. So let's go here. So this user's cost had 85 in there, but when I ran that historical utilization, they were around 130% utilized. So basically the adjustment I did was for the month of December, and because so many extra hours were worked, the value of each of those hours is dropped to $76.62. So when I run reports financially, it would show me this adjusted cost for the time period of December. Okay. So this is how you answer the question of, I want a salary cost, and I want that salary cost I want to make sure is as accurate as possible, and if people work overtime, I want the cost normalized so that overtime hours are not considered. So when I run a profitability on a project, I will get true profitability for the company. By using more than one of these costs, you can actually tell the system this primary cost may be my cost, salary, adjusted, all that kind of stuff. And my second level cost could be my banded cost. Everyone gets 175 at this as a project manager, and I'm not going to change that. Every hour's worth that. Obviously, the profitability reports will be very different from that perspective. So when you're running this historical cost adjustment, hopefully some light bulbs went off. You're like, oh, I really would like to use this. So here's some things to consider first. Okay. First and foremost, you have to pick the time frame. If you pick December, or a month, stick with a month. Don't do a month and then decide that you want to do a week and then do another month and a week. And so you want to keep a consistent time frame so when people run reports, they understand whether things have been adjusted or not. Include only the people who need a cost adjustment. Contractors, for example, should probably not be included in cost adjustment because they may charge you every hour they work regardless of how many hours they work. So they are not really necessarily a consideration for that. Then the harder ones to think about are what projects should be included. So I talked about when I ran that December report, I said I included everything. Company holidays, people's vacations, sick time, client work. So, a great example is like the first week, the week of Memorial Day for the U.S. There's a holiday there. People typically take vacation. There's an end of month, and people sometimes work. They'll work on client work that same week. So if I work, I take a holiday, I take 1 day of vacation, then I work 3 10-hour days. Okay, and using an 8-hour day, that is 46. Let's see, 8 and 30, 46 hours in a week. Okay, but I actually only work 30 hours in that week. So is it 46 hours that you're using or 30 hours that you're using for cost adjustment? It's something to think about on things because really the only overtime that was done was the 6 hours except you had a company holiday that week. So there's usually a bigger discussion as to what contributes to that user's percentage that would impact the cost adjustment. Okay. So these slides just show you how to run that report. I just already walked through that and overriding those. The caution I have to give you on this with the overrides is that the override values, these cost adjustments, only work on the primary or the first level of cost. So if you turn on multiple costs, keep in mind that if you're going to do this, the first one, the first cost in that list are the only things that can be modified with this process. The other two can't be modified with the report. Okay. So as far as using this type of feature, best practices are things like having a single person ideally, or maybe just a very small handful of people are the ones that are responsible for running this cost adjustment, and advertising when that cost adjustment is going to happen. Of course, you can't do it in advance. You have to wait until the work's been done. So do you do it at the end of the month? Do you do it on the first of the month for the previous month? Do you do it every week? Is it Monday at noon? Things like that. And then, of course, what things contribute to that percentage value. Just like people working more than 100% a week lowers the cost. If someone works less than 100% a week, which again is something to consider, do you include those people in there or not? If it's less than 100%, it will increase the cost per hour because they're assuming that the person is still getting paid 40 hours even though they may have only worked 30. Okay, so it works both ways. So definitely something to consider, and if you ever want some advice, the OpenAir user community is a good one, or just give us a call. Now there's another cost that people can consider using, and it's used quite often, and what that is a cost override, not a cost adjustment, and a cost override. And what a cost override is basically restating what the cost per hour is going to be at a project or even at a task level. And if you have more than one level identified, you would be able to override even those 3 different levels on the project level. So I'm going to show you this for a second so that you can see what I'm talking about. So I have the cost override feature turned on for projects. Now I scroll to the project of the Edit Project form. You'll see this loaded hourly cost override value. And what it allows me to do is redefine the cost per hour for a specific person, and I can do it across each of those 3 levels. So why would you ever use this? One option that is used quite often is when there is an intercompany or a transfer cost. So a person could be borrowed from the UK to work on a US project, and their normal cost to the company may be, £60 per hour. But there's an agreement that when the US uses them, the UK cross-charges them at a cost plus or a cost relief type rate. So they may be charging the US £70 per hour for the cost of that user. So it covers their salary plus any administration for the whole intercompany invoicing activity. Another is if you have sort of an open contract with a subcontractor and the rate is defined by the work, you could identify the subcontractor's rate on the specific project or even the specific task they're working on. And of course, if there's a target bill rate that you want to consider based on one of those levels, you could always adjust that out per project too. If you had we thought the project was going to be, we estimated originally to be at bill rate X, the actual bill rate was Y, and then you'd be able to compare estimate versus actual. So you have this override option on projects and tasks. How do you get to that on a report? And this is where the fun part is. Okay, when you have this override feature available and you go to a report, you may have seen these before, but maybe the definition wasn't quite clear. And hopefully after this presentation it will be clear. So you came to timesheets and you keep seeing things like actual cost and current cost. What's the difference between actual cost and current cost? What that means is timesheet actual cost is coming from that override value. It's going to come from the task, and if there's nothing on the task, it'll come from the project. And if there's nothing on the project, then it's going to go back and look at the user. So if you don't have any overrides, actual and current are exactly the same thing. But if you have an override, actual is the override value. Current is always coming from the user record. Okay, so let me repeat that in case you weren't clear on that. Actual costs comes from overrides if they exist. Otherwise, it'll be the user cost. Current cost comes from the user cost. And really what that allows you to do then is you can actually create intercompany revenue reports, basically, where you take the cost that you charge to the other country minus the cost of the user to your own company, and the difference is the transfer rate, or basically the intercompany revenue that you would have earned based on transfer policies. Okay, so there's some options there in using just the combination of these two standard fields and a custom calculation to create quote-unquote revenue values. Okay, so that's all about hours and labor. Expenses, of course, are costs against the project. And as you enter a receipt in the system, it's cost against the project immediately. Now, I do have conversations with customers about per diem. Per diem is a bit tricky. Really, if you're reimbursing people for per diem, then the cost of the per diem is what people should put on receipts so that that's what the cost hits the project. If they're getting actual reimbursements, but you're doing per diem billing, the actual reimbursements, the actual expenses are what are hitting the project, and you may be losing revenue or ideally at least breaking even if you're doing per diem billing back out to the customer. So the way that you handle the per diem policies in your company is really dependent on whether it's cost or not, again, in your system. And purchases, of course, are costs, but there's a couple things a lot of people may not realize about the purchase orders themselves. So there's two main types, a quick PO and a purchase order, a full purchase order, which comes with a purchase request process and the ability to track fulfillments. Basically, we get approval to spend this much money, maybe buying 10 servers for a customer, and we only buy 2 at a time. So you're fulfilling the purchase order, 2 servers at a time until you use up the whole purchase order. So a quick PO, many of you may be using a quick PO. It is actually the simplest way to capture cost against the project. You basically create a quick PO in the system. You put a cost against it. You pick a product usually. It could be services, material, whatever you define the product list to be. And you pick the project and you save it, and that it's instant cost against the project. Now, when I said you do it, it could be anyone doing it against the project. It does not have to be, wow, I'm recording it on behalf of Joe Schmo. You don't have to log in as Joe Schmo to create a purchase order for Joe Schmo. You can actually just create it as you against the project. You don't have to be associated to the project or anything. So the quick PO is a great way to, a lot of people will use that as sort of some data loading options or just some quick captures of vendor invoices that come in and just throw the quick POs in the system. Purchase orders, however, are more involved. They're usually where you have to get approval for a larger amount of funding perhaps, and maybe it's a subcontractor that you'll be giving them, you're issuing a customer PO to them, which is basically a vendor PO for you. And as they work it and invoice you, then you draw down against that vendor PO. The thing that I want to highlight here on purchase orders is that when you do a full purchase order, not a quick PO, a full purchase order that is not fulfilled, and you say, I need $10,000 for services from XYZ person, even though you may have a fully approved purchase order, none of that money is cost against the project until it becomes fulfilled. And as the fulfillments are entered into the system, each fulfillment amount starts hitting the cost of the project. Okay? So if you're not sure what I'm talking about here, purchases. Here's a purchase order I have. And here's an outstanding PO I have. And this PO, I've fulfilled 55 hours of a 74.5-hour PO I issued. So I have 19 left. So I've only incurred 55 hours of cost on this project. I still have another 19 hours available, but that cost is not hitting my project. Okay. I do want to point out that on reporting, though, there is still a missing reporting option when it comes to reporting fulfillments for purchase orders. So I threw that into this reporting section here. If you're using a full purchase order and you're fulfilling it along the way, when you go to run a profitability report against that project, for example, the intermediate or interim fulfillments will not show up on the report, no matter what date value you pick. Only completely fulfilled POs will show up as cost against the project. That is a known issue with OpenAir, and they are working to resolve it. But the example that I give people is on this report, the date to use for purchase values. It's a bit misleading, but it says purchase item fulfilled date. But the key is fulfilled in past tense. Fulfilled means completely fulfilled, means the entire PO has been used up. So if you use the purchase item date, you can include the full date of the purchase item, but there's no cost against the project. If you use the fulfilled date, it will include all the cost of the purchase item. But if you have a partially fulfilled purchase item, a purchase request, you won't be able to include the accurate value on the report, just to let you know. Some other things to consider when you're dealing with costs, especially with the cost levels. I said that you can prevent people from being able to see certain cost levels based on their role. Okay? And that is actually pretty powerful because a lot of times if you hide a field on a form, people can still come to the reporting area and see that field if they wanted to pull it. And they may not know what that field even is because they can't see it on the form. But when it comes to cost, OpenAir is very serious about the security around cost. So these are the roles, if you haven't seen a role before. And here the roles allow you to grant permission specifically to people to say that you can see all costs, or maybe you can only see the third level cost, tertiary cost. Okay? And people with this role, for example, if they tried to run a report that was using some other cost as a base, they would get a big red message that says, you do not have sufficient permission to run this report. So they may be able to see the report, but they can't see the values in the report, and they can't run the report. When they go to look at the values to include in a report themselves, they will only see anything related to the third level of cost in this example. They will not see any primary or secondary cost options. So that's a really good control there in order to make sure that people are not able to finagle into seeing the data in the system. Okay. And then the last one I haven't mentioned yet is dates on expenses. Now, dates on expenses are pretty tricky, and it really comes down to the intent of the report and the timing of the report. And the great example is if your expense reports are open expense reports, which means you don't have any period requirement on it. It's not week by week. It's just create it today and throw as many receipts as you need to. You know, maybe people do them once a month or something. You know, putting a date of June 4th on your expense report, but you have receipts from May and June in there. Okay, so where do the expenses hit? Do they hit in June? Do they hit in May? You know, when do you want them on the report? So the dates that are available do actually work on reports. They work very well on reports. Now it's up to you whether the receipt date drives the inclusion of a certain time period or the expense date, for example, does. So in a minute, in summary, what I wanted to point out is that there's lots of ways to track costs in the system, not just expenses and purchases, but the hours, and lots of ways to manipulate the hours to be aligned with the way that you need your KPIs reported on, your financial margins reported on, and even your transfer rates, for example. Costs are more than just the timesheets that are put in, and the policy procedures that you guys have in place, you really should be able to drive how you run the OpenAir. OpenAir shouldn't drive a change in your policy. So OpenAir's got enough robust features that should be able to support the policies and procedures that you guys have in place. I want to thank you guys all for coming. And of course, one thing I left the last webinar with at the very end that I also want to make sure I cover again here as well is that we are continuing to put tips out on the website, and we add them to the OpenAir user community LinkedIn group. But we did pull them together into an ebook if you would like to download the ebook and have them all in one convenient place. Of course, they're all of last year's, basically up until I think the end of April. We pulled them all to the end of April. So we're putting new ones out there, but this is about 50, I think it's 53 tips are in here. So just go onto our website if you would like to download this ebook. It's available for the iPad, for your ebook. The only thing we couldn't do is a Kindle, so you can download the PDF version if you really want it. And it's only $3.99. So hopefully that'll be just as helpful as this webinar without all the coughing. Okay?